Hello, I'm Joe Laux, the managing partner of Silverhawk Financial. Today, I'm pleased to introduce Greg Laux, who's the CEO and Chief Investment Officer at Affinity Investments. Greg earned his MBA from the Paul Merage School at the University of California in Irvine and a Bachelor of Science in Chemistry from UCLA. So he also holds the Chartered Financial Analyst designation. And Greg brings to us the 30 years of experience working with a variety of firms, handling a wide range of clients and building a well-earned reputation for his quantitative approach to investments. We're pleased and proud to have him at the helm of our core portfolios. And I wanted to just have a quick conversation with him today as there's a lot of volatility and we want to get his take on things. So Greg, thanks for joining me today.
Thanks for having me, Joe. That was a mouthful, so let's do it.
Perfect. Well, let's jump right in. 2020, geez, that's already in the past. 2022 has had a very rough start in the stock market. And I know with the backdrop of rising rates, people are getting a little bit nervous. Perhaps you could spend a couple minutes discussing what you make of all this.
Yeah, it is a little nerve-wracking, and we forget that this is probably normal. Historically, the annualized volatility, the amount the market moves, historically has been 20% or more. And what that really means is 2/3 of the time, the market will go up 20+% or down 20+% in any 1 year. So that happens 2 out of 3 times. I think we're all a little spoiled over the last decade with what's been happening. Actually, the volatility on stocks has been relatively low. So it does seem like we're a little bit of fish out of water because we haven't been used to this type of volatility. And candidly, 1/3 of the time, markets move even more than that. And so we saw that during COVID. We actually saw a 30+% downturn and then a recovery that was again. So the volatility is nerve-wracking. And I think a little bit more today is, I think we can attribute some of this rotation, which has hit some of the growth stocks hard, is due to inflation.
Oh, I'm so glad you mentioned inflation. People are asking us about that all the time right now, especially with the media coverage. One can easily get concerned about it from a headline hype. Can you talk about what Affinity is doing and what they're seeing in regards to real inflation, and what does that mean to the portfolios?
Well, inflation, let's talk a little bit about inflation. And again, we've been taking advantage of what has been for the last decade, low inflation. And in fact, we've griped about deflation. And that's actually been good for some of our assets. Yes, stocks have done well in a low interest rate environment. Bonds have done well in a low interest rate environment. In fact, when inflation is so low, we get a real rate of return on bonds. And so it is going to be a different world as we go forward. And the market has pulled back to reflect really the realization that we're going to have higher inflation going forward. Now, the good thing is that inflation, a big part of the inflation is caused by a growing economy. So we have to take a little bit of the good with the bad. After COVID, a lot of pent-up demand. COVID was a recession. Right. And so whether it's like the great financial crisis or COVID, and so there's a recovery, and that recovery starts to influence inflation. One of the things we feel good about is then how is the economy? Where does it stand? And so we look at what's called the current leading economic indicators, right? And those are still positive. And when you look at jobs and you look at unemployment, the economy is still growing. It's just not going to grow as fast. So that's number one. Number two is this inflation is caused by something unique, or maybe not so unique, but something which people don't understand fully, which is the expansion of the monetary supply. So during COVID, a lot of money was literally dropped from helicopters, right? And that money floods the system. And it's good because in the US, COVID, or the impact of COVID has been short and the recovery has been good. And so we can't, sort of deny that things are pretty good coming out of COVID, or it could have been much worse. So in the markets, what we're seeing is a little bit of a rotation in this correction. So higher inflation means high stocks that have high duration, like bonds, or have future earnings, they're going to come down in valuation. So people have rotated because of this higher interest rate environment out of the FANGs, right? So Facebook down 40%, Amazon, Google, Netflix. And, those stocks were trading quite high. So whether it was COVID or any of these things, those have stretched valuations. And so people are selling those and rotating into what we think are more service and travel. And that's interesting because today we had a lot of pent up demand because people had to stay at home. And so despite what we think is happening in the economy, there are parts of the economy that are still going to be strong, particularly service. So try to get an plane ticket, or try to book a hotel, try to go to a restaurant. There's maybe a third less restaurants, and they're all, packed. So part of this is a rotation out of high price growth stocks into more cyclically or economically sensitive stocks like energy, a little bit of the financials, materials. So a little bit of rotation as opposed to sort of a correction that we might have seen during the financial crisis where everything was down.
Right.
In this case, that's not the case.
Well, good. Well, it sounds like there's some optimism. So as we look ahead into 2022, what should our clients keep in mind with regards to where their money is and how we're managing it?
Yeah. So we have set the portfolios up, and I think rightly so, to participate in the continued recovery, and to stay away from some of the high value growth stocks, which we have to admit were stretched. And so in the portfolios, we have sold the growth names, actually even prior to this pullback. Right. And I know everyone looks at the S&P 500 and they think that's the market. That's actually more growthy in the S&P 500. And so in their portfolios, what we call faded growth, and we've put more into value. And so value has done a little better. Dividend paying stocks have done better. As we go through this period of time when maybe some of the earnings will be more uncertain, quality is going to do well. So quality and dividends, which those sectors tend to be energy, which I know people didn't like a year and a half ago, right, but is up 50%. So that sort of supports the idea of diversification. Financials have still done okay, though they've come back. But in a rising interest rate environment, it's been shown that financials and value stocks tend to do better than growth stocks. If we were to see growth stocks start to rally hard, my sense is that would be because we are getting to a higher probability of a recession. But I still think that right now, recession there's some probability, but it's not likely yet. And so the portfolios will have a little more value. In the fixed income side, which I think that's probably where people are going to notice something, is that the fixed incomes portfolios haven't done as well. But we have, prior to this and through this period of time, lowered the duration, which means lowering the interest rate sensitivity. We've raised the dividend by getting into TIPS, and TIPS are Treasury inflation protected securities. So they're designed to fend off the negative impact of inflation on bonds. And we think the Fed has more tools today than they did in the 70s. And so in the 70s, it was natural to use interest rate policy to raise interest rates to combat inflation. Today, if we notice, the most recent recessions and sort of crisis modes have been relatively short because the Fed has used the money supply to help the economy recover. Obviously, that means building the balance sheet and potentially printing money and then spreading that money around. This is the case here during COVID. The money supply was grown. Now they're going to purposefully shrink the money supply. But we have faith that the Fed believes the economy is still strong enough to take on a little bit of interest rate rising and reduction of the money supply. I will say that the banks, so when we look back at the mortgage crisis and the financial crisis, a lot of that had to do with the balance sheet of banks, but banks have huge reserves. In fact, the reserves that they have are almost the same level as post the financial crisis. And when you think about home building, and I know there's some sensitivity about home building, there's not a big overhang of homes for sale. So we think that part of the market, home sales, will not be as strong, but we don't see a big collapse there. So we're rather positive that some of these moves are the correct moves. And if there were to be some dramatic slowdown in the economy, the Fed would act accordingly. So we think the Fed is sending a signal that they feel the economy is still pretty strong enough to take some of the actions that they're taking.
Got it. Well, there's a lot coming down the pipe, and obviously we'll continue to pay attention to it, which you guys are obviously doing on a regular basis. So I just want to thank you for your time. And again, this is just a quick little one to hear your insights, and I really appreciate it. So thank you for joining me, and we'll look forward to talking to you soon.
Thanks again for having me. And I forgot one comment. We'll see at the end of this week. There'll be an announcement. We'll get to see if inflation is starting to moderate, and that will be a good sign.
Very good. Well, thanks again, Greg, and we look forward to seeing you soon. Thanks.
Thank you, Joe.